Rahmanir Rahim. Now we are starting Unit 5. Unit 5 is about accounting and finance. The first chapter, which is chapter number 28, is called business finance. Now, first of all, we need to define what is finance. Finance is the money required to start a business, to operate it, to expand it, and to do research and development. Now, the money required to start a business is called startup capital. The money required to run the operations of a business is what you call as working capital. Now, the working capital is, the theoretical definition is it is the money required to run the operations or day-to-day operations of the business, but it can be defined mathematically as well. It is the difference between current assets and current liabilities of a business. After that, we jump on to a few more terminologies. Since it's the first chapter of Unit 5, we are going to come across quite a few terminologies. One of them is the revenue expenditures. Money spent on day-to-day operations is called revenue expenditure, or these are the recurring expenses. The expenses which repeat themselves again and again are called recurring expenditures or revenue expenditures. The examples of revenue expenditures are obviously, all these expenses which are paid as rent and advertising and, all the utility bills. These are revenue expenditures. And then capital expenditure is, all the money when that is being spent on non-recurring expenses, the expenses which are not going to repeat themselves, the expenses which are one-off in nature, the expenses which are spent on acquisition of non-current assets are called capital expenditures. Now, the capital expenditures, when we are talking about them, whenever we buy a non-current asset, an asset for a long, which is there with the business on long-term basis, just like motor vehicles and land and building, whenever they are acquired, all the expenses which are incurred on acquisition of those assets are called capital expenditures. Then we jump on to a concept which is called liquidity. Liquidity is the ability of a business to pay off its short-term debts. All the debts which are for less than 1 year, the ability to pay them off is called liquidity of a business. Then we talk about another concept which is called liquidation. Liquidation can also be called bankruptcy. It is when the operations of a business are closed down due to either insufficient funds or due to illegality of the business. So, liquidation is the process of closing down the operations of a business either due to insufficient funds or due to other problems that are there with the organization. Okay, we are discussing different terminologies. After that, we are going to basically talk about once we are done with these terminologies, which we started with the finance and the startup capital and then working capital and then revenue expenditure and then capital expenditure, all these definitions. Finance, we said that finance is required to start a business, to operate it, to expand it, and to do research and development. So what is the purpose of finance, or why is finance required? We know that at least 4 different reasons we require it. Where does it come from? What is the basic what are the different ways in which we are able to get that finance? The finance or the sources of finance are the next topic. We have internal sources of finance and then we have external sources of finance. The internal sources of finance are the sources of finance that are available from within the business, and the external sources of finance are the sources of finance, or is the finance that is coming from outside the business environment. So when we are generating finance from within the business environment, we are talking about internal sources of finance. What are internal sources of finance? Retained profit. So now when we are looking at limited companies, we are talking about retained profit. Sole traders do not have any retained profit. Partnerships do not tend to keep any retained profits. So when we are talking about retained profits, we are talking about limited companies. Owners' personal savings are going to come into play when we are talking about sole traders and partnership. Then we have sale of assets, which is always an option for generating more finance for the business. And we are talking about reduction in expenses or deferring or delaying the expenses, which can be termed as, or which come under the scope of internal sources of finance. Then the external sources of finance. When we are talking about external sources of finance, we are going to have three different parts of external sources: short-term external sources, medium-term, and long-term external sources of finance. Short-term external sources, when we are talking about them, they are obviously available for less than 1 year. We are talking about short-term bank loan, which is for less than 1 year, and we are talking about bank overdraft, which is a special facility available to special customers or large-scale customers of banks, where they allow businesses to have a negative balance in the bank account. And then we talk about other sources of finance, which are short-term external sources, in which we are talking about debt factoring, that is selling the debts to collection agencies who can collect money on our behalf. And then further extending this topic to a concept which is called trade credit. Trade credit is when you are able to buy most of your purchases on credit. After that, we talk about medium-term external sources of finance. The medium-term external sources of finance are basically the sources which are available usually for 2 to 7 years. So 2 to 7 years, we are talking about medium-term bank loan, which is available for that period of time. And then we are talking about operating lease, that is hiring the premises for 2 to 7 years. And then we are talking about hire purchase installment method, which is sometimes also called financial lease or capital lease, where the business ends up buying the non-current asset by paying in small installments. It helps the business in conserving its liquidity. So that is a method which is going to help business in keeping its cash intact, so that the working capital requirements can be met. Then we talk about long-term external sources of finance. The long-term external sources are for 8 years and beyond. When we are talking about 8 years and beyond, we are talking about long-term sources of finance. Issuance of shares. We are talking about different types of shares. We can talk about preference shares or ordinary shares, or further types of ordinary shares where rights shares or bonus shares may be issued to generate more finance. Then we have issuance of debentures, which are long-term loans having a fixed amount of interest attached to them. And then we have a long-term bank loan as well, which may be used by the business as long-term external sources of finance. In special circumstances, for risky businesses, sometimes a special type of capital is generated, which is called venture capital. So that is also a source of finance which may be utilized for long-term purposes. This is where this chapter is basically going to end. Assalamu alaikum.